but they were very, very smart.
Yes, they got very rich.
Very, very smart.
And very smart and very rich, yes. And very high grade, by the way.
Yeah.
Jim Simons.
Had you invested $100 in the S&P 500 in 1988, it would have grown to $4,000 by 2021. Now let's imagine, to earn a higher return, you invest the same $100 in Warren Buffett's Berkshire Hathaway. You could walk away with $15,200 from this investment by 2021. But hold on. What if I tell you there's a fund manager who grew $100 into not just $20,000 or $50,000, but to a mind-boggling $3.25 million in the same 33 years? Sounds unbelievable, right? We are talking about the mathematician and billionaire hedge fund manager Jim Simons, who changed Wall Street forever. He's not just your typical hedge fund manager who can't even beat the S&P 500. Nope, Jim Simons is a rare gem. The man who actually managed to beat the odds and make his hedge fund profitable. This quant king outperformed the S&P 500, one of the greatest asset classes of all time, by 1,000 times. His hedge fund outperformed Warren Buffett by 250 times and beat investing legends like George Soros and Peter Lynch. His net worth was little more than $2 billion in 2005, which skyrocketed to about $22 billion in 2019. Even though Jim Simons, the enigmatic quant man, is arguably the greatest hedge fund manager of all time, much of his investing techniques are shrouded in mystery. But we're going to tell you everything, well, almost everything, that is in the public domain. Jim Simons once summed up his life in these following words, quote, "Well, the short talk is this. I did a lot of math. I made a lot of money, and I gave almost all of it away. That's the story of my life." Now, while this brief statement aptly summarizes his life, the journey has been quite eventful. James Harris Simons was born in 1938 in Brooklyn, Massachusetts. From early childhood, he had a keen interest in numbers. His love for mathematics took him to study the subject at MIT, and then complete his PhD in mathematics at the University of California, Berkeley. He wore many hats before venturing into the fascinating world of investing. Simons taught mathematics at MIT and Harvard, cracked Soviet spy codes for the US government, and developed mathematical models for defense forces. He is also an authority in the study of pattern recognition. In 1974, he, along with Chinese-American mathematician Xiang Chern, developed the Chern-Simons form. This work contributed to the development of string theory, which was one of the leading theories unraveling the mysteries of the universe. This is probably one of the most unlikely backgrounds of a fund manager who literally solved the stock market. Brimming with confidence, 40-year-old Jim Simons wanted to apply his mathematical modeling techniques in currency trading. In 1978, he started an investment company, Moneymetrics, a name that combines money and econometrics. The company used both fundamental and technical analysis to beat the market. But the results were not as good as he expected. The company lost millions of dollars and almost reached the verge of bankruptcy. Simons understood it needed a more drastic and data-driven approach to benefit from hidden patterns in the market. He wanted to take out all emotions, judgmental bias, and the entire human factor out of the investment to focus solely on hard numbers. It was the birth of Renaissance Technologies, the revolutionary hedge fund he established in 1982, which would later become the most successful hedge fund ever. In 1988, Renaissance launched the legendary Medallion Fund, which has since outperformed nearly every other investment portfolio in history. It uses extremely sophisticated mathematical models, most of which are closed, guarded secrets. All we can tell is that the fund has literally achieved the unachievable. Jim Simons is most famously known for his magical quant fund Medallion. It generated a 62% annualized return before fees between 1988 and 2021. Even after accounting for fees, the fund achieved a 37% annualized return during the same period. To put these numbers into perspective, $500 invested in the Medallion Fund in 1988 would have grown to an astounding $16 million by 2021. Why do we think these numbers are astronomical? Well, let's compare the performance of the Medallion Fund with an average hedge fund. According to data provided by Hedge Fund Research, or HFR, in the 10 years from 2009 to 2018, hedge funds have generated an annualized return of 6.09%. Now, let's compare Jim Simons' performance with other top investors in the world. When it comes to the average annual return, he has performed better than the best names on Wall Street, including George Soros, Stephen Cohen, Peter Lynch, Warren Buffett, and Ray Dalio. In comparison to Medallion Fund's 39% average annual return between 1988 and 2021, George Soros' Quantum Fund achieved 32% between 1969 and 2000, while Stephen Cohen, Peter Lynch, Warren Buffett, and Ray Dalio achieved 30%, 29%, 21%, and 12%, respectively. But if those numbers haven't blown your mind yet, get ready for some more jaw-dropping facts. The Medallion Fund has a slightly negative correlation of 0.41 with the S&P 500. This means when most investors are bleeding red in the market, the fund is busy raking in profits for its investors. In 2008, when the S&P 500 lost 37%, the Medallion Fund went up by 82% net of fees. From 1989 to 2005, a span of 17 years, Medallion had just 1 year of loss, which occurred in 1989. In 1994, the Medallion Fund delivered a staggering net return of 71%. And as if that wasn't impressive enough, in 2000, it astonished investors with a nearly impossible net return of 98.5%. After all these impressive returns, the next obvious question is, how has Jim Simons really cracked the investing code? Well, the first and short answer is data. A researcher from the fund said, "There's no data like more data." Jim Simons follows one simple rule of thumb: remove all emotions from investing. Emotions lead to investing errors like averaging a losing position, revenge trade, and decision paralysis. By relying on models and scientific methods, you can keep biases at bay and let your models achieve results. Researchers working with Simons collected and crunched terabytes of data long before any other investing firm. Renaissance collates and analyzes any data that can have even the slightest effect on market returns. So, if a drought in the Midwest U.S. has historically affected the grain market, Simons' team has probably analyzed it already. Not only does the team collect data from formal sources like earnings reports, government publications, and academic papers, but it also takes into account more obscure data like opinion pieces and newspapers. Now, how many years of data do you think Simons and his team have crunched to create profitable trading setups and models? 25 years? 50 years? 100 years? Hold your breath. Simons referred to investment data as far back as the 1700s to model even the smallest and shortest fluctuations in price. A researcher from the firm said, quote, "Renaissance's goal was to predict the price of a stock or other investment at every point in the future. We want to know in 3 seconds, 3 days, 3 weeks, and 3 months." The fund has poured millions into high-end disk drives and processors to process, store, and analyze vast amounts of data in search of patterns that outperform the market. It has been digging through mountains of data, employing advanced mathematics, and developing cutting-edge computer models, while other investors relied on intuitions and old-fashioned research models. This rigorous approach ultimately helped them build formidable trading setups. Since the researchers in the firm are vowed to secrecy, there is hardly any public information available about the particulars of these trade setups. Now that we've seen the power of data in Simons' approach, let's dive into the second key ingredient to success: high-frequency trading, also known as HFT. This is yet another thing that Jim Simons' firm truly pioneered. The company executes hundreds of thousands of trades to scalp tiny profits from each trade and accumulate millions of dollars in cumulative profits. In the beginning itself, the Medallion Fund clocks between 150,000 and 300,000 trades per day. But there's one more critical aspect to Simons' success: modeling human behavior. According to Jim Simons, human behavior is quite predictable, even with its humongous complexities. Faced with dangers, we are wired for a so-called fight or flight response. When the chips are down and investors sense danger, their instinct is to dump their stocks and bolt from the market. What Jim Simons has successfully done for decades is model human behavior to profit from the market. Now, you would expect an investment fund of this stature would hire professionals with a degree in finance or portfolio management. But this cannot be further from the truth. In fact, Renaissance will stay away from hiring you if there is even the slightest touch of Wall Street in your resume. Rather, Simons' firm picks the best talents from a pool of PhDs in physics or mathematics. Renaissance has often been called the best physics and mathematics department in the world. Observing the Medallion Fund's impressive track record, you might be wondering how you can invest your money in the fund. Well, the bad news is you can't. Since 1993, the doors of the Medallion Fund have been closed to outside investors. Instead, the fund only manages the assets of Jim Simons and its employees. So, not only can you not discover their trading secrets, but you can't even get a share of their profits. Jim Simons retired from Renaissance in 2010, but he still serves as a non-executive chairman and advisor. So far, Simons has donated more than $4 billion to philanthropic causes. The Simons Foundation, which he co-founded with his wife in 1994, is working on a mission to advance research in mathematics and the basic sciences. Jim Simons established himself as one of the greatest investors ever by beating the market through mathematics. However, another legendary investor always believed that outperforming the market is much simpler than most assume. He even entered into a $1 million bet with a leading hedge funds manager to prove his theory. Click the thumbnail on the screen to watch our video about it. This intriguing story baffled the entire investing community. Thanks for watching, and we'll see you in the next video in a moment.